Welcome to the channel. Don't forget to like and subscribe. Today we're going to talk about probability in the law of large numbers. After knowing how to apply the law of large numbers in insurance, you may also be able to understand that in the insurance world, the more people who join insurance, the more accurate the predicted losses will be. In addition, under the law of large numbers as well, insurance companies can form tiers. The levels of the company will be divided into two, namely as follows. The first one, mortality level. The first level is the level of mortality. Mortality level is the frequency or number of deaths. This of course relates to life insurance. Therefore, the level of mortality is one of the basics in determining life insurance premiums, one of the levels that emerge based on the application of the law of large numbers. Second, morbidity rate. Next, in the level of morbidity, this level is the frequency or number of illness, injury, or disability and events that have been insured. Just like the level of mortality, the level of morbidity is also one of the bases for determining the insurance premium that must be paid by the client. As explained before, the law of large numbers is the legal basis for insurance, including life insurance. In simple terms, the more people who follow insurance, the greater the accuracy of predictions regarding losses. Probability is basically a possibility that is often encountered in the daily lives of clients. These probability factors are inherent in insurance. Meanwhile, the various probabilities in question are this first one, a priori probability. The first type of probability is a priori probability, an event that has been known in advance or can be predicted. For example, someone who is old and registers life insurance. The insurance companies know their age and various medical history. Therefore, the probability can be calculated and can be predicted. Second, empirical probability. The second type of probability is empirical probability, or the possibility based on empirical or experience. This probability refers to events that can be known from experiences and activities carried out daily. For example, a worker who works in a factory, in the worst case scenario, the worker will have an accident while working. Empirical probability is a principle that is widely applied by insurance companies, especially in life insurance. Let's take another example. From 1,000 people who are 20 years old, how many people have managed to reach the age of 21 years? The data is then collected and processed using statistical data with the law of large numbers. The use of these two kinds of probabilities is very important in insurance, especially in life insurance. By using these two kinds of probabilities, the possibility of losses that we experience in the future can be assessed and can be used as a basis for determining insurance policy premiums. The last thing to understand is the facts and exceptions to the law of large numbers. This section is important to understand, especially for an insurance agent, because it is something that must be conveyed to prospective clients so that there are no misunderstandings. There are maybe thousands of insurance companies in the world. However, there are only a few insurance companies that are known and successful, even though they provide similar insurance services. If so, why are there only a few insurance companies that dominate and grow into giants in the insurance industry? What are the things that cause that to happen? There are at least a few things that cause it to happen. One of the reasons, insurance companies that do not grow do not have the skills to handle insurance. The law of large numbers is only a theory that is used as a principle and foundation in insurance. Of course, in its application, the law of large numbers can determine company profits. However, the company's profits are also determined by the ability to maintain operational efficiency, calculate premiums effectively, and reduce losses after claims are submitted.